All right, now we live. Yo.
What's up, family?
What up, everybody? Just a smidget bit late today. You feel me? I promise it was for a good reason. But we here though, so we not even gonna trip on the time. You know what I'm saying? I know y'all family, so I know y'all gonna be understanding. You feel me? Just like I was understanding last week when you came in the chat and said, dang, I'm late. I gotta catch up. I ain't say a word. We say not one word. So we gonna show us the same respect. Just know AJ and Dave wasn't late. So you got any smoke directed my way. But appreciate you, AJ. Appreciate you, Dave. Got another supplemental Sunday ready for the people. I think this your third time, Dave, on supplemental.
I did the second one for this season.
Second one, but you done been on Sundays about 4, 5, 6 times. So
yeah, about 4 or 5 times already. Something like that.
Yeah. If you a cousin, look, if you a cousin, you know this name, you know this face, and you know the work that he brings. So we definitely appreciate you. Gracing the stage again. You know, he hit me, told me he has something to say. I'm like, hey, listen, I'll fill in the date. Just let me know when. You know what I'm saying? So we got him here today. Definitely don't want to waste any time since we already did start late. So Dave, I'm gonna let you go ahead and take the floor, bro.
I appreciate you, family. So actually, I'm gonna have to turn my video for this one. So now, about last time we spoke, we kind of covered like economic narratives, and let's just put it this way: those houses prices that we talked about in January that were looking really good. Not gonna lie, they were. The block was way too hot, still is. So instead of trying to acquire everything all at once, spend all that money on renovation, understand that the house has potential to be shot up and continue to have a lot of risk that might impact the value of that home. Just think about that for a moment as we start reviewing all of this. Okay. So we're going to talk about game theory in the stock market and really the use of algorithms. And I know it's not everyone's favorite cousin right now, but you know what? She does have a point, and I'm gonna have to bring it up straight from ARK Invest. And this is from December, where Kathy basically pointed out, and I'm gonna kind of read it from here, is as the case though in the depth of the coronavirus last year, quant and algorithm-based strategies seem to dominate the stock market actively, though in the first 3 months of the rotation earlier this year and again recently. By some estimates, algorithm trading accounts for roughly 70% of all trading in the US, and even higher percentages during periods of heightened volatility. Okay. So now, just want to kickstart that and keep in mind that during heightened volatility, we see a ramp up of algorithmic trading. So let's talk about game theory for a little bit. So now game theory, in this sense that we're going to be reviewing today, can be applied to just a number of different businesses, field from finance to economics to political science, psychology, so forth. I mean, they're popular ones that we're going to talk about, and there's a couple of less known ones. And what it does, it really creates a system or framework to enhance one's reasoning and decision making in a very complex world. That's basically what game theory is, but we're going to go into more definition. All right. So according to Investopedia, game theory is the theoretical framework for conceiving social situations among competing players. In some respects, game theory is the science of strategy, or at least the optimum decision-making of independent and competing actors in strategic settings, right? The key pioneers of game theory were mathematicians John von Neumann and John Nash, as well as economists Oscar Morgenstern. Okay. So again, we're trying to enhance our strategic ability to make decisions in a complex world, right? Again, that's the focus of today's presentation. So how do we apply this to the stock market, right? Well, we're going to understand some of the players that makes the stock market very complex, such as other investors, the Federal Reserve, governments, and corporations. I mean, when it comes to the stock market, these four players are going to impact your way of how you actually strategize your investments, right? When you're building your thesis and you're building you're about to take your position, you need to start evaluating all these other four players and how they're going to impact your investments, right? So now you know the players. So what ultimately you can do in the market? Well, you can either buy, short, hedge, limit order, stock, buy bonds, buy real estate. I mean, this is not just, or buy REITs or dividend funds or dividend stocks. So there's a sheer amount of different strategies that you can use to be able to get a return on your investments, right? So the way that this contracts with value investment is that investors should not be given too much weight on other investors' opinion. So value investors really don't care about other investors' short-term opinion. All right, they're thinking long-term. They're not worried about the day-to-day fluctuation in prices, all that noise, which we're going to talk about in a bit, right? So again, the main objective for us is that game theory is we're going to use this to analyze data, right, that we collect from the stock market. We're going to model our findings, right? We're going to predict decisions made by the business to understand what different scenarios will produce a stable stock market or a stable price action, right? That's what we're doing there. So we're looking at decision making. We're looking at the different deterministics, like things that will determine whether we're going to take one of these positions up here. We're going to look at different probability, right, to understand what our returns might be. And then we're going to look at uncertainty and risk, right? These are all the things you as an investor got to think about when you're thinking about strategy. So let's talk about strategy for a little bit. Now, Mark mentioned this several times since 2020 about this book called Thinking Strategically by Dixon and Nailbuff, which is in this book. It really goes along this whole talks about different strategies that you can implement when approaching just different decision making within your life, right? And one of the most famous examples that is used in this book is called the prisoner dilemma, right? So in here, we got two scenarios, right? We got a prisoner, they both commit a crime. Let's say they robbed a bank. And so there's prisoner A and there's B, right? They're partners together. Now they both can betray each other, right? And each will serve 2 years. Or they both can stay silent and each of them can serve 1 year. Or if one person stays silent and the other person betrays the other person, right? That person that stays silent is going to get 3 years. The person that, betrays the other person can get 3 years. So can actually get out free. So now these are different scenarios that here when it comes to trying to understand whether you should make a decision or not make a decision. All right. Now, that's just an example of really thinking strategically, because at this point, you're thinking about what is the outcome that can happen. So you're thinking about like, what's your payout, right? And then you're also thinking about your risk. So your risk is prison time. Your payout is freedom. So, but this can be applied to a lot of different applications in our life, not just the market. Okay. But let's take a look and see why this is important, right? Why we have to think strategically in the market, right? What's going on? Well, here's the problem, right? Today on Wall Street, stocks tumble as news circulated that the guy in booth 6 ordered only coffee for breakfast. It's getting where everything seems to impact the stock market. That's the problem. The problem is that there is so much going on in the world is that it is hard to really understand what is going on with your investment, what's going on with your company, and in all the different ways that that company can remain profitable or actually taking hit. There's a lot going on. There's some things that might have nothing to do with your investment, but because the market overall is sensitive, let's say like the war in Russia and Ukraine. Well, yeah, the war in Russia and Ukraine hitting company like, for example, Plug Power. Plug Power shouldn't get a hit for that because they're in the renewable energy space. Actually, lessening oil or from Russia is actually a catalyst for that company to do well. So understanding things like that, like, hey, how the news impacts your investments, that's what we need to uncover here. So that's why we need to figure out how to think strategically and why we need to go on this journey. So how we do that? Something called decision tree, right? Now, people that are in software engineering, programming, I know your developers might know this, or your project managers or scrum masters, you might be very familiar with this. And what this is basically or think of it like a video game. As you take a step, you got a decision you got to make. The answer is either yes or no, right? And then you go on to the next decision until you figure out where's your ultimate, route. And as you start doing this with your investments, you need to be able to be critical as far as what makes an investment a sound investment. But let's start here with what impacts our personal life. So I'm looking for a new job, right? And here's my criteria. My first criteria before I even talk to a recruiter or even entertain a hiring manager is, is my salary at least $250,000? Is it yes or no? If it's no, I'm declining the offer, right? If it's yes, then next question, what's my commute? My commute more or less than an hour? If it's more than an hour, I'm declining that offer because it's impacting my stress and my work-life balance and the risk that I have to manage, right? Think risk management, right? Or if it's no, then next one would be silly, like, hey, does it offer free coffee? If it offers free coffee, I accept the offer. If it doesn't, then I decline the offer, right? So that is one example of decision tree. Let's look at another one that actually impacts the stock market. So when we're looking at like stock market here, we can think about it from this ratio. Hey, is the PE ratio of the stock greater or less than 15.07 here? If it's yes, then we move on to the next set of criteria. Is it on its 10-day moving average, right? Plus or minus, or if it's less than 5% of its 10-day moving average, which means it might be under support. Then the next question is, hey, is the MACD at 0.0, or is it going up, or if it's going down? Or another question would be the RSI. Is the RSI greater or less than 50? So right here, what we just did was we just created a list of how we can just say, hey, is this a good technical setup, right? So all our technical chartists probably have a list of what they need to find before they take a position for a scalp. Well, you should be able to do this with your investments. So we're going to come down and we're really going to see why this decision tree is really important. But here's the thing, it's not natural for a lot of humans to do that, especially when they're getting an influx of noise coming at you, right? The hell is coming again. The world is about to end, nuclear arms race, Great Depression. When you start hearing all these narratives, it kind of spooks you out of your position. So, you know what smart monies do? smart monies use trading bots, right? The reason why is because when it comes to humans, humans may not control their actions in a fit emotion. Trading bots, they're completely cold-blooded to emotion. They don't care. Man, when they say institutions and smart monies don't have emotions and they're cold-blooded, yeah, their algorithms are even more cold-blooded, right? So you can't be at a computer and you track trends around the clock. Sorry, for those that have a 9 to 5 and think they can scalp and day trade all day, very difficult, because it takes that one phone call, that one meeting that was unexpected, that one email that you have to answer real quickly, that one coworker that just shows up in your office unexpectedly can make you miss your exit or miss an opportunity to buy. Or you might miss a news or a tweet or a different alert that might be able to set or be a catalyst for your trade, right? Now, trading bots, they could scan the stock market around the clock, not only without interruption, not only they could scan the stock market, they could scan a bunch of other things that you didn't think that were actually related to the stock market, to various stocks, right? Humans cannot quickly and accurately calculate market changes. I'm sorry, I can't tell you if the market is going to move 2.5% any given hour. I can't tell you what direction is. I can probably give you an idea, but I can't tell you to the exact second, to the exact minute, to the exact price. I can't tell you any of that. Some bots right now are sophisticated to the point where they can actually predict to the penny, most likely where the market might go, based on different sets of criteria and conditions. I'll leave that there. Now, humans can make a mistake completely by accident and that can lead to a loss. Bots are programmed to eliminate random errors. Like an error I made is I accidentally bought a put when I meant to buy a call and wrecked my portfolio. It happens. We all had that one act when we got distracted and we accidentally made a move and we were supposed to do something else. So again, that's the difference between algos. So let's take it even a bit further, right? I want everybody to realize that everyone has access to the same information. Smart money just analyze it a little bit better. That's because they have algos to do it. Right? So these algos can perform repeatable tasks better than humans. They lack emotions like greed and fear, anxiety. So that's very important that we need to understand that. Okay. So, boom. Oh my God, this is overwhelming. What's going on here, Dave? What's all this stuff, right? So again, these are just example of things that algorithms are looking for, right? Economic theories, different price patterns, different white papers or different analyst research report, market events, right? It's looking at new machine learning algorithm. It's looking at live observation of the market, different sentiment, social media, all that stuff. New data sources, things like a blockage on the sea by a large, the Suez Canal, something of that nature, or a small mom and pop's fund being over leveraged and borrowing a lot of money from some large institutions that were also over leveraged, right? Or different blogs and articles, right? They take all these, they make all these different ideas. They have the systematic trading. They use the data to really understand two things that they really need to understand: cost and quality. And then they go down and they go even further, trying to really predict like different sizes, what the performance matrix supposed to be, what the interest might be that might impact the stock, what's the dividends, and basically all those Greek letters that impact your contract for your options. Yeah, all that's taken consideration. But damn, right there in my little Timothy Rogers voice. Why should we care? Why should we care about this? So, and I don't want to go over everybody's head, but this is really why this is so important. Yeah, I know the book, The Art of War by Sun Tzu. If you know your enemy and know yourself, you need not to fear the results of 100 battles. If you know yourself and not the enemy, for every victory gained, you will suffer a defeat. If you know neither the enemy nor yourself, you will succumb to in every battle, right? Very important. Know your enemy, right? So if you're trading against a bunch of algos, then I best believe it will be important to understand how those algos are trading and how to spot those opportunities and where they're trying to go and which levels they're trying to break and what the sentiment is overall for the market, right? Now, knowing yourself, and there's one book I put here by Daniel Goleman, which I truly believe everyone should take an opportunity to read, especially if you're like in a leadership position, because it really helps you be aware of your own emotion objectively and also the emotions of other people as well, right? Now, the reason why is it very important to understand your emotional reaction or your drive, your fear, your motivation is because these impact the market, right? Understand there are people out there taking contrarian placements or positions based on your emotion, okay? So here's another book. So here's another quote. If your enemy is secure at all points, be prepared for him. If he is in superior strength, invade him. If your opponent is temperamental, seek to irritate him, right? Pretend to be weak, that he may grow arrogant. If he is taken his ease, give him no rest. If his forces are united, separate them. If sovereign and subject are in accord, put division between them. Attack him where he is unprepared. Appear where you are not expected. That's really important. That is extremely important, is to understand like everything that's happening in the market. Think of it as a game or strategy, a game of strategy that you're playing, where you're basically going against an enemy. So you got to basically figure out what the other side is trying to do. That's trading. Okay, so let me go back. So let's talk about different common type of algo trading, right? So there's mean reversion, statistical arbitrage, momentum, trend following, market making sentiments. And we're going to walk through all of these in a very high level. And reason why, because I just want to bring awareness to all you cousins as far as what is happening in the market, right? It's all going to start making sense. So mean reversion, I mean, this is basically like a phenomenon where like asset prices and volatility will eventually return back to their long-term average. So let's say like a 200-day moving average or, like the 50-day moving average. Well, these are basically just, hey, prices returning back to its mean. So it's correcting, it hits a resistance, and then basically it's overbought. What happens? It corrects back into its average. And then from there, investors are waiting for what's the next catalyst on the mode to actually put more volume into that stock, which will then will push the price higher. That's how mean reversion works, right? It basically is just like, hey, this is trading outside its average. You know what's also mean reversion? Another good indicator to kind of figure that out. Bollinger Bands. You ever heard of standard deviation? It just means how much a price action moved outside its average. So one standard deviation just means it's one move outside its average move. Two standard deviation is two moves outside its average move. So when we say it's on the top of a Bollinger Band, it's twice outside its normal move. So something out there is unusual. I'm not saying that it's a good time to short a stock or buy a stock. It just means that's something where you need to question what's the price action going on with that stock. Okay. So that's mean reversion. Another one, statistical arbitrage. Now, the way this works is think of this like a correlated trade, right? Or group trading. Think of like American Airlines, JetBlue, Delta Airlines, right? They all try to trade together because that sector and industry and the sentiment that investors have for that industry is very similar, right? So you'll see those stocks in that industry trading similar. But what you'll notice is that sometimes we'll have that one outlier that trades a little bit behind the rest of its sector, or it trades ahead of that sector. So what happens is that these algorithms kind of go through and they sense like, yo, there's this stock right here that's trading outside its sector. That's an opportunity to trade. It's called the catch-up trade, right? So that trade is trading behind. So you could think of this as just a way to employ diversity. I mean, it can be any random correlation. It could be a statistical arbitrage could be like every time there's a snowstorm, Generac, buy Generac. Why? Is because historically Generac does well when there is a snowstorm or there is a outage. That's statistical arbitrage. It's using statistics to basically say, based on these criteria and these conditions, the stock will most likely move like this. That's how you get that opportunity. That's thinking strategically. Next one, momentum, all right? This is when we just expect the volatility to be elevated for a stock, right? It could be a play to earnings, that momentum into earnings. There's going to be more volume into that. Or they can be at an event like, you know, like a new Apple, you know, analyst day, you know, that can be, or Tesla AI day, elevated event, because people are anticipating that one more thing. So there is some type of narrative, there is something that's trending that's causing more attractiveness for investors to get into that trade. That's a momentum trade. So there's algos out there that are basically saying, hey, 14 days before this earnings, take a position in Apple. Here's another trade, trend following. So what's the difference between trend following and momentum? Well, trend is just that. It literally is a trend. It's basically looking at the longer term trend and saying, hey, there's more volume. It's not making lower lows. It's making higher lows. It's making higher highs. The trend is showing that it's healthy and it's going to go up. It's not consolidating. So this is a technical trade to go up. There's algos that do this. There's also screeners that do this. They follow the trend and say, all right, this is a good trade. How about the next one? Sniffing algorithms, one of the most complicated ones. We call this the stalking algos, right? So this is exactly what basically what it is doing is just stalking all the different type of algos, creating all these what if scenarios, saying if this happens in the world, then these are the type of trades that happen. Basically, this is the playbook, right? And it's creating a position or play to take opposite of different setups in the market. So let's say that you have a long-term call on QQQ, right? Cool. I got some 2024 leaps in QQQ. Solid. Problem is that I know that the Federal Reserve, based on the new data showing that, hey, interest rates are going to be higher. You know, Powell said that he's going to higher up and he's not taking 50 basis point raise off the table. So that means that everything is indicating that in the short term, growth stocks will take a hit, which is heavily in QQQ. So what I do is, knowing all the scenarios, in the short term, I could take some profit off the table off my leap, and I could take a short position to essentially take an opposite, like buy puts to cover my calls. So right there, that's protection. That's basically just using different scenarios to kind of figure out what is an opportunity to buy or sell, right? So this is a little hard one because it really takes into consideration a lot of different variables and a lot of things in the market, but it's exactly what it's doing. It's literally figuring out what different algorithms, and then figuring out what's the next position to take. Now, here's another one: market making and order execution. All right, so with this one right here, this can be this can't really be deployed by retail traders. I mean, this is kind of like seeing whale volume, like unusual volume. So let's just say that Adidas is going to do share buybacks, right? So we know that they're looking to do share buybacks for, let's just say 50 million shares, but they can't buy that shares all at once, right? They have to buy them in phases, because if they buy it all at once, they're going to, spike up the price of that stock. So what they do is they literally have these cipher, like these set orders that are basically going to be placed on different days, on different price actions. Like, hey, when this stock pulls back, 2.5% in any given day or 5% in a day, trigger a buy. All right, that's your order execution flow. It doesn't matter what happens. Like if the stock pulls back, gives you a certain amount of drawdown, I don't care what happened in the world, buy more. Or if something's occurring and the stock hits a certain, like a stop loss, then sell the stock. So that's how we can do it as retail traders. But a lot of institutions have the ability to see, because they're paying for order flow. They see what's the opposite side taking, and they can basically get into trades and execute faster than most retail traders. So that's the market making order execution type. And the last one is the sentiment analysis, right? So for here, I mentioned earlier, hell is coming. So Bill Ackman, this is basically just like influencers that have the ability to move the market based on the sentiment. Or it can be like recall. This isn't news. This can be a media moving price action, right? News comes out like, hey, there's a recall on Tesla. The sentiment comes out in the market all over Twitter and IG that, hey, these Tesla cars suck because of, a certain component. And then the stock starts selling off because of all the negative news that's around that stock. Right. So again, this is basically based on just straight sentiment, right? Fear and greed, and this is something that you can look out for. So again, this is being aware of all these different scenarios here. Okay. Now, let's bring this all together. So why did I have to go through all those exercises as far as like all the different algos that are out there? Well, because our mission, in the comment series and just all the cousins out here, what we're trying to accomplish is really teach everyone how to manage risk, how to maximize your profit by minimizing the downside risk against a singular position, right? That's important. Research based. We don't take trades based on, what Mark says, what Q says, what TiVo says, all great people that probably did all their homework, but you know what? It has to be based on your research. We don't follow just trends. We have to confirm our thesis. We have to basically say, all right, I see what they're saying, but I don't think that's going to happen right now. I think you might be a little bit too gun-ho and too happy trigger to pull right now. I think that's going to happen in an additional 3 to 6 months based on this. So you can agree with somebody, but have a different time horizon of when that can happen, which will impact your conviction in that stock. You might just not have the conviction right now. Doesn't mean that's not a good investment. It just means that it's not a good investment right now. So, and the more that we learn, the more we earn, ironically, but that's because we can basically confirm our conviction through our own thesis and our own confirmation, right? And then validate. All right, don't take your trades based on someone else's narrative or someone news headline. Go out there, look at the data, read an earnings report, listen to guidance, see what it was, listen to the sentiment or the emotional micro cues that were given during earnings to understand whether that's a good position or not. Because here's what's going to happen. We're going to get trapped. We are going to get trapped. Matter of fact, let me put my camera back on for this one. Because I'm going to tell y'all, here's the problem with market right now. We got this. Signal, noise, confirmation. I'm going to bring it back. I'm going to take the next couple of minutes to really talk about this. All right. So signals can be data entry points, you know, like a few wicks. And let's go through this example. Here's what signals are. Signals is just price action. It literally is a pattern on a chart. Don't really mean anything, right? Unless you want it to mean something, right? And enough people believe a signal means something, then it's going to mean something, right? If enough people believe that an inverted yield curve is a sign for a recession, guess what? My ass is going to be liquidating everything I had because I believe there's going to be a recession. So what I'm going to do is I'm going to arbitrarily and artificially create a recession because I believe there's going to be a recession based on a signal that says there's going to be a recession. There's a difference. So that's why we need to understand what these signals are, right? So you got to understand why. When there's a signal, you need to understand why, all right? Let's talk about more signals, right? There's signal strength, right? All right, let's talk about how bullish or bearish a pattern can be based on the size of that candle, right? And MJ did a wonderful job, you know, going over technicals a couple of months back. I urge everyone to watch that. But the reason I bring this in, because for me, every time I look at the candlestick chart, I just think of tug of war, right? Who's winning, buyers or selling? Or is it really bullish and there's no wick? Cool. In my head, that little flag basically covered the entire side. And that one team, either the buyers or the sellers move. One. So signal strength. That's what I'm caring about. Now, boom, noise. Let's zoom into this one. Because I need y'all to understand this. So noise. So market noise is simply all the price data that distorts the picture of the underlying trend. This includes, right, mostly small correction and intraday volatility, right? That's what market noise is. Market noise can be just like other people's opinion, different headlines, and all it's doing is just creating volatility. So then somebody can basically take opportunity, really quick trades, large volume to take advantage of the volatility. I'm telling you, there's some hedge funds that lost money last quarter, but there's some that won a lot of money because they were able to take advantage of volatility, understand what direction the market was truly going. Okay. All right, so that's that. Let's move on. Let's talk about confirmation, right? Here's the thing. All right, we need to understand future growth, profitability, and guidance alignment. That's all we care about when it comes to confirmation. Has the thesis changed for the underlying business model, right? Is there a risk to globally that can impact that company, right? Whether it's global social economics, health, or supply chain that will impact that company's customers, right? Or their cost. That's what really matters, right? Are these risks to the sectors, the industry, right? What is that company's moat? What protects them from all these underlying risks that are incurring in the world? And how can they mitigate that? Those are the questions that you need to ask yourself when you're in the trade. That's it. That's confirmation, right? When there's confirmation, or how about this? You set yourself for your expectations. You understand, hey, what the market is going to do, and you know when it's going to do, when you understand when that confirmation is going to be. A confirmation is like, oh yeah, Federal Reserve Powell said that, yeah, 0.50 basis points is not off the table. It can go higher, blah, blah, blah. He's not giving you confirmation. He's just saying we can do this, we can do that. We'll wait and see. Well, when's the confirmation of that that's going to happen? That's the FOMC statement. When the Fed fund rate comes out, that's basically telling you, hey, did we actually raise it by 0.5 basis points or not? So till then, people are going to talk their talk, right? So what's going to happen? The algos are going to basically take over. When the algos take over, you know what they're going to do? They're going to trade between a range, right? They're going to, when there's uncertainty in the market, they're going to retest. What's retest? Oh, I highlighted this one point. Okay. A retest refers to prices reversing direction after a break and returning to a breakout level to see if it will hold. In case the break to the upside, for example, after initial wave of buying has run its course, prices may stall and trigger very short-term profit-taking selling. The tendency is for prices to return to the breakout level, which should now act as support and attract buying interest. Or a mean reversion. See how that comes together? So basically, price action is returning back to the mean, right? It's returning back to that breakout level. Why it's doing that? It's doing that because it has no real reason or confirmation to continue going up or down. It's just going to be range bound. It is what it is. You just got to recognize it and be able to trade between those ranges. But what can we do as other strategies? So I'm gonna let y'all know some stuff that I do. Okay. I layer my position. And this is actually a real life example of what happened in Q4 of last year. All right, took some positions in September and wrote it out to December for PFE. I was really bullish on that. If y'all follow me on social media, y'all notice I was talking about Pfizer a lot last quarter. And the reason why was because I was basically playing, my catalyst was the COVID-19 pill, right? That was my thesis, my catalyst, winter was coming, a resurgence, all that. So that was and when it came to levels, I plotted my levels on a 3-month chart, looked at quad witching, I looked at, hey, we ever retest that breakout level, I'll buy some more. And then also, if there was a previous level, let's just say that we retreat even further. So I'll do like 25%, 25%, 50%. And the only reason I do that is because it's just a strategy for me to say, hey, this can happen, that can happen. We're not necessarily risk on or risk off yet. And I don't mind averaging higher if my thesis is right. Or if my thesis is wrong and say, hey, listen, this is not working out, then I have enough cash on the side to take the opposite side of the trade. Boom, bang, done. So that is something that you do, is one, having cash on hand and then having a strategic approach, say, hey, listen, I am doing this off of technical levels, or I'm doing this based on economic levels. So I can say, hey, I'm going to do this on the FOMC statement. I'm going to take a trade when the CPI number comes out. I'm going to take a position when the Federal Reserve FOMC interest rate has actually go up and the Fed fund rate came up. So what does that mean? That means that these are 3 different days. I don't care what happens in the market. I evaluated all my thesis, understand that this company is a sound company, and just say, you know what, I'm going to just layer it in over time. So that's one strategy, right? So I really encourage everyone to invest with purpose and plan accordingly, right? Because this is not chess, it's checkers. So, hey, Tivo, AJ, can I rock for another 10 minutes?
Bro, do your thing.
All right. So let's talk about this a little bit more. Matter of fact, we'll do this. We'll take a pause. I butchered this last time, so I'm going to come back to this and then we're going to move forward. So last time I spoke about in the book Narrative Economics, I talked about the Keynesian beauty contest, right? This economist that had this beauty contest, and basically was trying to get people to choose what was the actual prettiest, or they were trying to win a contest, right? So John Maynard Keynes, who I mentioned earlier, was one of the founding fathers of game theories and also modern day economics, macroeconomics. Basically had entrees basically choose up to 6 faces, right, of 100 photographs. Everyone who picked the most popular faces was entered to raffle for a prize. What is the strategy and why would it work? Strategy was not to pick up who you think is the prettiest, but to pick up who you believe others found was pretty, right? So again, you're looking to win the prize. So it was your job was to be amongst the few contestants that actually had the most amount of popular picks, right? Right. So entrees or investors, faces or stock tickers, raffles or for prizes or profit, right? So now the reason why investors care about that is because other investors will buy in the future, right? You have to care about what investors will buy in the future because you want to be able to sell to them at a higher price. So you often pay more for asset because you believe that it's going to go higher, right? And so this is another strategy in game theory we call the greater fool theory, right? Remember, we're talking about narratives, we're talking about FUD, we're talking about FOMO, we're talking about all these different ways that a strategy that are implemented to get retail traders or most investors to be shaken out of their position or chase after another position. Why? Is because they're trying to sell you an asset that they paid for a cheaper price. They're all trying to offload to you, right? So what you're seeing a lot in the market is this greater than fool theory, right? Sometimes prices just rise because people expect them to rise. So it's all speculative. Like, can someone tell me why GameStop is still, in the $100? So there's still a lot of stocks like that, where you'll see that they just rise 20% out of nowhere. No, it's because they're creating an emotional stimulus to get you to react a certain way, right? So now, what can you do to battle that? Again, thinking strategically, moving accordingly, right? You have to basically consider this when you actually making your trades. What is your maximum risk, right? Mark and Jolene talk about risk and rewards quite a bit, right? Especially in the early days. They talk about don't risk it more than you can willing to lose, right? We do the 70-30s. Some of y'all doing like the 97.3% and thinking that y'all can run up credit cards and take cash advances so you can take opportunities in the market when the market is showing that there's still a lot of risk. And you're complaining that, oh, the market is rigged and it's not. You talked about it plenty of times. Sometimes we just get trapped in the whole sentiment of the market, all the noise, that we're not really building a sound thesis that allow us to evaluate whether investment's a good investment or not a good investment, right? So that's the thing that we got to understand. So, what's our break even? What's our entry points for each side of the position? What are our exit points? What we're taking profits, our stop losses, when are we rolling to the other side of the trade? What are the seasonality factor? What is of your underlying stock? As this will determine your entry and exit points. That's it. The market's 2 things: entries, exits, and then position sizes in between. But that's all that matters. You either make money by your exit, the stock or the asset was worth more in the exit than when you entered, then that's the ultimate goal. Congratulations, you won. If not, then you need to evaluate why your entry was bad or your exit was bad. Did you get greedy? Was there an emotional trigger that allowed you to stay in the trade a little too long, or that fake you out that position? Remember, we're trying to think strategically here. We're thinking strategically. We're removing the emotions from our trades, right? And then also plan our budgets to put position and layer in quarterly. Now, I mentioned a layering position earlier. That's because I'm never 100% sure. I'm a rookie at this. 5 years in the game, I'm still new. There's still a lot that I don't know, right? And that's because I don't trust myself, and nor I'm not behind the boardrooms of some of these companies, so I don't know what the true health is of that company. And neither do you. We can speculate here and there, but we don't know what's really going on behind closed doors. So, last but not least, how can we get through this whole algorithm and all this exacerbated game theory that's being used in the market to kind of fake us out our positions? Well, one, have a good checklist to go off of. So you cut once, you measure twice. But this is something I've shared on all my social medias. Y'all follow me. And the one thing is a swing trading checklist I've been using, which is the reason why I'm still heavy on a lot of cash, because are we on a risk on or a risk off environment? Currently right now, we're in a risk off. I mean, look at where the market is compared to where we open for the year. We're still approaching down, what, 8%, 7%, 7-8%, something of that nature. So that's still very bearish. You know, what are the factors in the risk? There's still an ongoing conflict. You know, not to scare anyone out of your position, but I want to test your conviction, right? You know, what's the risk in that company? I mentioned this, right? Shows a global risk. Let's talk about volatility. You know, what's the VIX compared to previous week? Is volatility elevating or is decreasing? You know, what's the narrative for that sector? Like, all right, so Lockheed Martin. In a wartime environment, you would think a defensive company would continue to do well during a defensive, during a wartime environment, right? So when it pulled back, and you understood, no, it's pulled back because the overall market pulled back. That's actually an opportunity. Then you just found a glitch in the matrix, an opportunity for you to actually take advantage of that, right? Or how about this? When regional banks are supposed to perform well in a high interest rate environment, given that lending is still going up and given that people are still buying and willing to spend, right? If all those three check off, then regional banks shouldn't be selling off. That's a glitch in the matrix. That's just opportunity to get in. So going through this checklist really makes you understand and evaluate whether you're actually taking a gamble or true sound investments, right? This is a true opportunity for you to take advantage of some volatility and some price action. You know, that's really what this is doing. And lastly, you know, what are institutional investors' position? Actually, we don't even care about what institutional investors are doing. What are some of the theses and what are the approaches that institutional investors are using to be able to come up with their backing, their reasoning, their mode to why they get into a trade? So by understanding that, then you understand exactly how to move accordingly, right? You don't have to worry about following the whales and seeing, and trying to see where the volume is going here and there. You already anticipate it because you're seeing the same thing they're seeing, right? Now, you might not be able to have all the information at this very same moment all at once, but if you get really good at this and you really focus on a few concentrated amount of stocks or industry or sectors or even companies, you'll be able to read that company, be able to read that sector and industry and anticipate what is some of the risk factors and what's the moat that drives volatility and investors into that specific sector, industry, company, right? So asking all these questions and really going through these exercises here is going to make you a solid investor and is going to allow you to not be faked out set the right precedents and right expectation of how to maneuver around this market. Be able to see through the BS, right? Because you're able to look at the data and interpret it and say, you know what, the data is saying something completely different. You know, everything else is noise. Or, you know what, this is not the right environment to go in right now. So I'm going to just wait until I get some confirmation and I'll buy the stock higher. Because they're buying a stock high and it going higher is still better than buying a stock low for it to then go lower. So with that said, I bid y'all farewell. That was me rambling. Thank you very much for your time. Just kind of wanted everyone to understand how to think strategically, why Mark recommended this book in the first place. Yeah, see that? Think strategically. And just really just getting us prepared, because there's a lot of noise in the market, right? Especially the way price action is moving. Earnings are still, looks still pretty strong. Guidance looks strong. Airline is looking good. Hotels looking good. Economy looks like it's still flourishing, but now we're talking about possible recession and Great Depression. So, so this is when you have to be able to interpret yourself what's going on and understand when your confirmation is going to happen, because then you can be able to sleep at night and trade between the volatility. So
that's exactly why I'm looking forward to this week's earnings.
Word. Yeah, you got some good ones.
What? I need all the guidance this week. Like, I need all the guidance. Okay. All the guidance. But we appreciate that, Dave.
No problem.
Coming through with the gems as usual. As usual. My favorite part, I would say, is that decision tree, though. Like, understanding the framework of how to frame your trades. Like, it could either do this or this. And what am I going to do if this, or, if this? So I like that a lot. Appreciate you, brother.
No, I appreciate y'all, because if it wasn't for those bulls versus bear exercise, I would never have that type of framework in my head where I'm thinking, well, this can happen, well, that can happen. So that ability to see both sides of a trade and an argument at the same time is what makes you dangerous.
Mm-hmm. Yeah.
That's a fact. Well, yeah, we appreciate you, bro. There was a few slides in there that was real helpful, even for me. So I know, if you got to take a screenshot, whatever you got to do, make sure you pay attention to those, because again, it's adding additional layers every single Sunday. We're trying to add an additional layer. This was like a critical thinking layer where he's not only breaking down why Mark recommended that book, because Mark has never really gone super in depth why he recommended that book. But this was a good example of how to use that information from that book and apply it to the stock market. You feel me? Because the stock market, at the end of the day, is psychology. There's stuff with companies and earnings and this and that, but it doesn't all move how you think it should move, or how it's based on earnings or money or the economy, because a lot of it is psychology. It's people buying and selling and finding value and losing value. And, so you have to be able to critically think to be able to move throughout the market appropriately. So we definitely thank you for breaking that down, Dave. AJ, I'll let you go ahead and do your thing.
See, there's one thing I do want to say about this. For AJ. Essentially, like, I think it's important for us all to develop like a system where we can implement strategic thinking. And the reason why I say that is because a lot of folks don't have that scientific or engineering background that kind of teach you logic reasoning. Mm-hmm. And because they're not used to like reasoning and really picking apart and deciphering what's really happening with a lot of data and information, they just go blind faith in trades. And because they never established the conviction, it takes one move and you shaking out the market and you're like, yo, this is not for me. So just that rationale and having that abductive thinking is exactly what we need to develop here. And I thank all of y'all for helping us develop that.
Hey, that's a fight. if we could save one person from blowing their account, or if we could help one person get to that next, 4-digit account, 5-digit account, 6-digit account, that's what we here for, man. We really here to help. We're not here to confuse, to hurt. We saw what Mark and Jolene doing on a broader scale, and we trying to funnel it in to make it all make sense. You feel me? So thank you for taking part in that, for sure. Because a lot of this type of thinking, like you said, we not groomed to do that. Like our teachers in school do not care if you know how to critically think or not. They trying to get you just to the next grade so you could get up out their classroom. You feel me? Like a lot of these public schools is not the business. You feel me? Especially if you're in a major city, Atlanta, Memphis, like these public school systems is not it. And a lot of colleges is the same thing. They just want your bread. They don't care if you learn how to critically think, So this is a skill that people having to learn on their own. And, we want to create an environment that is, respectful of that and is helping people to do that.
Facts. All right, y'all. So not gonna hold y'all too late. For earnings this week, it is jam-packed. Okay, so make sure you are paying attention. On Monday, we have Coke and also Activision. Shout out to UT. On Tuesday, we have UPS reporting. All right. So when you talk about global supply chain, all of that, be looking for some guidance there. We got Microsoft, Google, Visa when it comes to consumer spending, Chipotle, DR Horton with real estate. On Wednesday, we got Boeing with defense, Meta and Facebook. After Netflix had its crash, we're going to see what that's going to do for the communications next week, along with PayPal and Qualcomm. Also, Pinterest and Teladoc on Wednesday. Okay. Now, Thursday, we got Apple, Twitter, Amazon, Roku, MasterCard. We got Southwest reporting for airlines, Domino's, Robinhood, McDonald's, Intel, and Caterpillar. And then come Friday, it follows up with your Honeywell, your ExxonMobil, and Chevron. All right. So jam-packed earnings week. Conferences for the week. We got the Chardon Annual Genetic Medicine Conference. So as you see there, there's plenty of healthcare companies that are going to be reporting. So those of you who follow healthcare, that's a major conference for the week. And for your economic report, on Tuesday, we got the consumer confidence numbers coming out. We also got on Wednesday, crude oil inventories. Thursday, GDP and unemployment claims. And then on Friday, we're going to follow that up with the PCE price index to end the week. So y'all, for those of you who don't know, this is the last week of April. So let's see how we end out this month. And yeah, make sure y'all are paying attention and make sure you're doing your own DD and research if you plan on taking any trades this week. So, and please don't just be taking earnings lottos, y'all. Don't be blowing y'all's money just taking, willy-nilly earnings lottos this week either. Be smart. So that's my piece.
You're not about to cancel nobody lottery ticket. They still finna play them. They still finna play them. They seen what happened in Netflix. Hey, look, this is what they do every earnings. They let one of them major companies cash out, and then that's how they draw everybody in to keep playing lottos on the rest of the companies like it's going to be another one. But hey, to each his own. I'm not finna be playing no earnings lottos.
Listen, they're coming for people's necks this week with these lottos.
Too risky, man. Too risky.
Too risky. Listen.
I'm safe.
It is on you.
I'm trying to pick my money. You feel me? I done made plenty of donations in my lifetime. I'm trying to protect my money.
Listen, I need every dollar at this point. The way gas is, I need every dollar. Like, I
got two Chevrolet vehicles that do not do nothing for me in gas savings.
I'm gonna tell you this: did y'all let your investment in oil and energy pay for your gas prices?
You should.
Like someone have been saying since like.
He's been preaching XLE, y'all, since, listen, now if you weren't paying attention to that, T gave y'all the game on XLE. Like it was right there. He gave y'all the live.
He
What's
did.
crazy is that was my most profitable ticker last year, and I ain't even played it this year. But it's still, I still got money in my account from XLE just from
XLE.
last year.
I'm saying.
I mean, that was an easy play for sure. But yeah, man, keep your eyes out. Really apply this game. Really apply this knowledge, because you will make money off of it. I promise you that. If you apply these things that you learn, you will make money off of it, and you will save yourself from losing money off of it. Like he said, it's better to buy a stock as it goes higher than as it goes lower. Buying a stock low and then going lower, you're losing money. Buying a stock high and then going higher, you're making money. The name of the game is to make money. So don't be catching falling knives in a market that is falling. The market is falling. You feel me? It hasn't found the bottom yet. So all this, you could play some intraday levels, some quick in and outs, but don't be just buying stuff just because it's low. You got to do way more homework than just seeing a low stock price, unless you really willing to hold for 10, 20, 5, 10 years. Because people that bought Apple at the high 5 years ago, or Tesla at the high 5 years ago, they eating now. But some of y'all that's playing options, it's not gonna be the same thing. If you bought Tesla at the high last year, you might be down right now. You know what I'm saying? So you just got to be mindful of what your strategy is. But Dave, did you have anything else for the people?
Nah. Thanks for the love and hearing me ramble. So appreciate that.
Man, you always welcome.
Yeah, bro.
About you, AJ, you got anything for the people?
No, just continue to learn, y'all. Continue to learn.
Continue to learn. It's that simple. Well, we appreciate y'all coming out on the Sunday, man.